Okay, let's continue our discussion on how to account for adjustments known as accrual adjustments and or deferral adjustments. This next section focus on what we call prepaid items. Prepaid item. What is that? Well, this is when an expense has been paid for in advance. An expense has been paid for in advance, such as rent or utilities. What we're saying here is that if I paid my rent for the entire year in advance, that is known as prepaid rent, which is an asset. However, each month, as my rent becomes due, I'll make an adjustment to recognize what's known as rent expense. Let me show you. All right. On March 1st, the date is important. So write down the date, March 1st. Write it down. You sure? Okay. Cato pays 12,000 cash to lease office space for 1 year beginning immediately. So they paid 12,000 cash for the entire year. So there's an account called prepaid rent, which is an asset that's going to increase by $12,000. But because they're paying cash, the cash account decreased by 12,000. This is an asset exchange transaction. We're exchanging one asset prepaid rent for another asset cash. This transaction doesn't impact the income statement, but the statement of cash flow, you will see an outflow of 12,000 under your operating activities. Now here comes the end of the year adjustment. Now remember that this rent was paid in advance on March the 1st. It is now December 31st. So we're asking what portion of that 12,000 has now become an expense. Well, that 12,000 covers rent for 12 months. Therefore, our cost is 1,000 per month from March 1st to December 31st is a 10-month period. Therefore, 10,000 of that 12,000 has now become what's known as rent expense. So we're going to make an adjustment. We're going to decrease prepaid rent by $10,000, recognize rent expense in the amount of 10,000. So remember rent expense, expenses decrease your retained earnings. Expenses are also shown on the income statement. So you're going to make the adjustment show what portion of the prepaid rent has become an expense by the end of the accounting period. Now remember that I said the deferrals mean that you cash has been received before either recognizing the revenue or recording the expense. Example, Cato received 18,000 cash in advance from Westbury Company for consulting services to be performed over a 1 year period beginning June 1st, year two. So we're saying now that we received 8,000 cash before we've done any work. So my question to the class, if someone pays you before you do the actual work, have you earned revenue? The answer is no, you haven't. That's known as unearned revenue, which is a liability because now you have an obligation to perform this service at some point in time in the future. So to record this transaction, your cash account increased by 18,000. That's your asset. Your liabilities, not revenue, your liabilities increased by 18,000. You have what's known as unearned revenue. It doesn't impact the income statement at this point in time, but your statement of cash flow, your cash increased by 18,000 from your operating activities. Did you follow that? All right. Now, keep in mind the dates of this transaction. We're going to begin work on June 1st. All right. So now, let's assume it is the end of year two. And we're saying how much of that 18,000 have we actually earned by the end of the year? Well, let's see. That 18,000 was for a 12-month period. Therefore, you're going to earn $1,500 per month. Now, from June 1st to December 31st is how many months? Let's see. Use your fingers. June, July, August, September, October, November, and December. That is a 7-month time period. So 7 times 1,500 equals $10,500. Therefore, by the end of the year, 10,500 of the 18,000 has now become revenue. So you're going to decrease the liability count, unearned revenue by 2,500, increase your revenue account by $10,500. On the income statement, you will show the revenue, and this adjustment has no impact on your statement of cash flow. All right? So this is just a summary of all the transactions that took place during year 2. I recommend that you do the account equation and record these on the account equation to make sure you can record all of these transactions. And then here are the adjustments that we made at the end of the year to make sure that all revenue and expense amounts have been recognized and recorded before you prepare your financial statements. The ledgers will show the ending balance for each account after recording all those transactions and making the required adjustments at the end of the accounting period. We'll use the ledger balances to now prepare our different types of financial statements. All right. So here we're going to show the actual income statement. So this is showing the actual transactions for year 1 and for year 2. That's showing the transaction, but here are the actual income statements. So for year 1, remember that we had revenue of 84,000, expense of 18,000, net income of $66,000. Year 2, total revenue 106,900, expenses total 67,650, net income of $39,250. All right. For our statement of change in stockholders' equity, remember from year 1 that we had ending equity of 71,000. So now for year 2, your year 1 ending common stock become year 2 beginning common stock. We did issue additional shares of common stock. 66,000 was the amount of net income that was the 66,000 was the year 1 ending retained earnings, which become beginning retained earnings for year 2. This was the net income earned in year 2 from the income statement. We paid $21,000 out in dividends. So your ending retained earnings was $84,250. Common stock 7,000. Total equity was $91,250. Then on your balance sheet, this is showing total assets. This shows total liabilities. This is common stock coming from the statement here, 7,000. This is your retained earnings coming from the statement, 84,250. To get total equity, the balance sheet has to balance. Your assets must equal your liabilities plus your stockholders' equity. On our statement of cash flow, this was showing the actual outflow of expenses for year 1 and year 2. So notice that the ending cash balance from year 1 is our beginning cash balance for year 2. Look at our transactions, operating activities. We had an inflow of cash of $54,800. Under investings, we actually purchased land for $79,500. For your finance activity, we issued common stock, paid out dividends. So overall, for year 2, your cash account decreased $40,700. Look at your beginning cash balance, $53,000. So our year 2 ending cash balance equates to $9,300. Okay? So when it comes to our different events, they're going to fall up under one of the four categories that you've probably been saying: an asset source transaction, which means there's going to be two assets involved, an increase in the asset and a claim against increases; asset use transaction, an asset account decrease, and a corresponding decrease in other cat; asset exchange transaction, where there's going to be two asset accounts involved, one goes up, one goes down; or a claim exchange transaction. Claim refers to your liabilities and equity. One claim account will increase, another claim account is going to decrease. So, I was going to ask you to identify those, but I see that I gave the answer already. So we're still going through it. So when you acquired 5,000 cash based on common stock, that was an asset source. So the asset account increased, stockholders' equity increased. When you cash provided 84,000 consulting services, asset source, your assets increase, retained earning increase. When you collect $6,000 in cash from customers, that was an asset exchange. Oops, didn't mean to go there. Go back. When you collect $6,000 in cash from customers, asset exchange, your cash account increased, but account receivable decreased. Well, now we paid $10,000 cash sale expense. That's the asset usage, a decrease in your assets, decreased stockholders' equity, cash paid for advertising costs, again, asset usage, a decrease in assets, decrease in stockholders' equity. When we signed that contract, that was not an actual business transaction as of yet, so it's not applicable. Received $6,000 of accrued salary expense. A claim exchange. For this transaction, your liabilities increase and your stockholders' equity decrease, and then a closing entry of the claim exchange because you're closing out the temporary accounts over to retained earnings. Okay? So be sure to review the Chapter 2 lecture videos. Complete your Chapter 1 homework, your Chapter 1 quiz, and your Chapter 1 homework, Chapter 2 quiz, and your Chapter 2 discussion lesson. If you have any questions, feel free to reach out to me. As always, have a great day.